Calling this week a roller coaster like week is almost an understatement. We've had several days where we were up to start the day, came down pretty dramatically, went back up, came back down, possibly pretty dramatically. That said, today we didn't come back down that last time. Now, I think the market and these kinds of moves show the market is getting something wrong, and that is the inflation outcome. I think the market has been severely misunderstanding what inflation will actually do to the market, and that has provided opportunities for those of you willing to catch the falling knife. The market hasn't seen inflation in the last 30 or 40 years. It literally just has not. The Fed has seen less than its 2% target inflation, and now all of a sudden it's expecting to see more inflation. But what the market has seen is rising interest rates. So as interest rates begin to rise, people say, oh, stocks must fall because interest rates and bonds are now more attractive assets. Well, there's a distinction between nominal and real interest rates. Real interest rates factor in inflation. And I believe the reason why bonds are ticking up is because of this concern for inflation. So bond investors want to be compensated for the fact that they are taking dollar risk, and they need to be compensated for that. And here's the thing. Companies, stocks, how are they valued? They're valued on earnings. How are earnings determined? The price at which they sell their goods times the amount of goods they sell and inputs. One could say that if inputs also rise, earnings aren't going to necessarily improve, and there won't be any sort of positive benefit on stocks because they are the sum of the cash flows. Well, I challenge this notion on two grounds. One, very simple equation, inputs and outputs equation. If inflation is happening at some level across the board, consumer price index increase of X percent, the only way a company is profitable is if the final sales price is greater than the price of the inputs. So you will see a greater increase in the output price, and the total earnings of that company will actually grow. It won't just stay the same. In addition, there are markets in which we have seen inflation. For example, the housing market. We've seen increases in input prices in copper, lumber, land, and labor, as well as increases in final sale prices, the actual price of the home. Yet we've seen a very hot real estate market that has inventories down 50% and price increases of 14% year on year. So it seems to me like with record savings and lots of stimulus, this economy will experience good inflation. I'm not saying inflation is a bad thing here. It's going to be good. But stocks are selling off into inflation. And as I've been saying for the last week plus, I believe that's the wrong move. And it's unfortunate, it's hit me, sure it's hit you. And I have advised to just ride it out. I haven't really sold anything. I've sold some stuff that isn't really moving up or down, and I don't expect to move. And I sold it to buy some stuff that has fallen significantly. And I view that as a benefit for this period. And I look to adjust and, win on the other side. So today was a good day. It was a good run. Hopefully we're going to see it continue and see a market rebound. That said, there are some things out there that do continue to make me nervous. And the way I'm looking at this is I don't want to try and time the market in the short term. I don't think that is something you should do either. I want to play the long game. And I think in the long game, the truth always wins. And I believe the truth is that inflation will help, not hurt the market. But in the short term, it's possible people who are convinced that rising interest rates have such a dramatic effect on the stock market might continue to send the stock market down. In addition, I'm not so confident all $1.9 trillion of this stimulus package is going to get passed. I think it really is sounding like it's going to be a fraction of that, but it could be something like 1.5. I don't know. We will see what happens, but I don't think it's going to pass in its current form. But the market has been expecting that and pricing that in for several weeks now. So the fact that all that money isn't flowing into the market might give the market some jitters. And a combination with that and possible rising bond yields might continue selling. Now, here's the thing. If there's less stimulus, there's likely less inflation. And if bonds are ticking up because there's inflation fears, well, if we get less stimulus, we should have less increasing bond yields, or at least bond yields should stabilize around where they are now. So it's unlikely that we'll have two forces, but it is highly likely we will have one of two forces that allow selling pressures to continue. The question is, has all the selling pressure occurred? And it looks like it has, because every day that we have these moves, we have a dramatic down move and we have a dramatic up move. And, there's some stuff that's still left as carcasses. Lots of tech is still a carcass. But a lot of the market also recovers. So we really just got to kind of wait and see, play the long game, have stocks that aren't valued at stratospheric valuations. That is how you get burned in this situation. And hold, really just hold on through, because I think the market is getting the inflation picture wrong, and I think we're going to be okay with inflation. So that's the deal for today. And until next time, peace out.